Peter.
Hey.
Hi.
How you doing?
How you doing?
I'm doing great. It's been a great weekend.
Yes,
Yeah.
yes. So you offer, please tell us a little bit about yourself for people that may not know.
Well, I'm multifaceted. I've been in the mortgage business for over 23 years, and the last 15 years working virtually exclusively with real estate investors. And but you know what? I discovered or realized a few years ago, probably about 5 years ago, that real estate investors were on one track and they were only focusing on real estate. And then you talk to financial planners, financial advisors, they're on one track, only talking about stocks and bonds and mutual funds. And it's like never the twain shall meet. You know, there was this gap, and people were having a difficulty getting holistic financial advice on how to develop a real estate portfolio, how to integrate private equity into that, or how to integrate their RSPs and non-real estate assets, and how do all these work together. So I'm actually licensed in all three areas. So I provide wealth management advice in portfolio management, private equity, and mortgages.
Excellent. So are you trying to tell me that getting a home mortgage is totally different from getting a mortgage when I'm an investor?
Yeah, absolutely. Statistically, Canadians who live in their home pay the mortgage, and the default ratio on owner-occupied residential homes is less than 1% in Canada. As a result, the Canadian banks feel very comfortable lending mortgages in the residential sandbox, if you will. But if you're buying a residential home as a rental property, that's where banks see more defaults. That's where there's more challenges. And for whatever reasons, there could be a variety of reasons, but there's where the highest defaults are. So as a result, banks have more of a scare factor. They're more timid in entering into lending to real estate investors. So if you're a real estate investor getting into real estate investor, you shouldn't let that scare you. You should just learn that you need a plan of action. You can't just go throw mud against the wall. You need to really have a well thought out plan and work with somebody who knows what they're doing.
That's interesting. So they're looking at it as a higher risk. Is that because people are not analyzing the property, like the properties, like strategically in a positive cash flow situation? Like why
Yeah, you know what? The reality is, so let's say you and I are at an event where there's education from stage, et cetera, and people are learning how to do it properly. We have to remember, in the big, broad scheme of things, that's a very small percentage of the Canadian population. A lot of people who buy rental properties aren't being educated, aren't getting advice from professionals, and they're doing one-offs or throwing mud against the wall. They don't know what they're doing, and they can easily get blindsided by making mistakes they're not aware of.
Sure.
And you know, so it's not like real estate investing is dangerous. Well, it's dangerous if you do it by yourself and you don't have a plan or you're not getting proper advice. So statistically, the percentage of mortgages that go into default at a bank are higher for rental properties than they are owner-occupied.
Interesting. So if somebody's just thinking about real estate investing, where should they start?
I can't emphasize enough, it's starting with a plan. I do something called the gap analysis, and that is a very simple process. You do an inventory of where you are today. So just write down everything about what you own and what your financial picture is today, good, bad, or otherwise. Don't judge it, it is what it is. And then ask yourself, if you're investing, what's your reason? Why are you investing? What results do you want? I used to, do seminars across Canada. The one thing I learned, it wasn't the real estate that people wanted. It was the results they perceived they're going to get from that real estate. At the end of the day, when you're 65 years old and you have cash flow coming in and you go down to Safeway to buy your groceries, you need cash. So whatever that future date is, everybody needs to get clarity as to what result you need or want from your investments, regardless of what those investments are. And then once you get clarity around that, work backwards to define, well, if this is the result I want, what should I be doing today to make sure my actions are consistent and in alignment with my future desired result?
Earlier, I heard you speaking with a lovely woman, and she was saying that she couldn't get her partner on board, and I actually hear this often. Do you have a suggestion for that?
Absolutely, the gap analysis, because if you sit down with your spouse or partner and the two of you have one simple question, by this date, and you can define what that is. It could be your retirement date. It could be the date at which you want to quit working 9 to 5, or it could be the date at which you want to be in a position financially to work because you want to, not because you have to. Whatever that is defined for you, the couple have to come on the same page. What is that desired end result? And then once you identify the desired end result, what needs to happen to make that a reality? So let's say one couple says, one partner says, I want to access equity to buy rental properties, and the other partner says, no bloody way. Then you just sit there and say, okay, well, here's a desired end result. We both agree on this. Here's one way I'm going to do it. I could envision we could access capital in our home, access equity, buy a rental property, and that will help us accomplish the goal. If the other partner says, no, I don't want to do that, then the question would be, well, then what's your solution? Because at the end of the day, if you both agree on the desired end result, you got to do something. And one of the things I always say to couples is, don't ever underestimate the cost of doing nothing. Sometimes there's a very high cost to do nothing. So as a couple, you got to come together and identify what that cost is.
That's excellent.
And that will help them come to, ideally, that process, and it is a process, will help them arrive at a point where they can agree on something.
Now, if somebody has a home already and they have a lot of equity, I don't know if you've come across this, but I know that I have as well, that people are saying, well, I want to sell my house, take that equity out, and then go rent. Do you have a suggestion on that?
Well, again, my analogy is a chessboard.
Yep.
So let's say that the objective of chess is to get checkmate. So what does checkmate mean to you? So if I'm sitting with a couple, I'm going to help them come to a conclusion of what checkmate means in their life. And then every decision you make should move you in the direction of checkmate. There's no right or wrong here. It's not like, well, you shouldn't do that or you should do this. It's what action are you doing, and is the action consistent with the desired result? Quite often, a lot of the actions we take financially are very predictable how they're going to play out. And when you play that out as if it was a chess game, you'll realize, whew, that's actually a dumb deal. That'd be a stupid thing to do. Or maybe you'll say, that would be a perfect thing to do. But you envision the action, play it out, and ask yourself a simple question. Will doing this action move me closer to checkmate or not?
What got you into real estate investing yourself?
I got in, interestingly, because I got into mortgages. And so I came about it through a different direction, and being a service provider to the industry, and then seeing my clients making money, and I go, hey, I got to jump into this too. So at first, becoming a mortgage broker. Second, within the mortgage brokering field, discovering a niche. And then once I was in that niche, I thought, hey, I'm not going to let my clients have all the fun.
So wealth creation strategies for sure.
Exactly. And some of the best coaching has come from some of the biggest mistakes I've made. And not even mistakes, adversity. I don't like to call them mistakes because life happens. We all get thrown curveballs, and that could be personal or economical, and some of those curveballs could be like the subprime crisis in 2008. Things that are completely outside of our control. So I wrote a book in 2010, and one of the chapters I had in there is called the what if clause. So what if a curveball hits you? Could you live with your worst case scenario? So one of the things I taught was that if you're about to make a decision and do something, like maybe go out on the edge, if your assumptions are false or something happens and that proves that it didn't work out the way you wanted it to, or the only way you're going to succeed would require Venus and Mars to align, then ask yourself this: if Venus and Mars don't align, would I be really disadvantaged if this didn't work? If the answer is yes, then maybe you should reevaluate doing it. But that's more along, how or why you should take risk.
Yeah.
But again, at the end of the day, for me, it all comes back to having a plan. Identifying and getting clarity as to why you're buying real estate, why you're making an investment, what result do you need from that investment, and then work backwards, reverse engineer the process, work backwards to today, and then make sure every decision you make from today moving forward is in alignment with the desired end result.
What do you suggest with media? I mean, they're a driving force in what happens with the market, whether it's up or whether it's down. So what do you suggest to us? I mean, it's everywhere on Facebook when we read it.
Well, again, that goes back to what I'm saying, my what if clause.
Right.
So if the media is right and you make a purchase based on a certain set of assumptions, if your assumptions are false, would that destroy you? Yes or no? If the answer is yes, that would really screw me, then don't do it. Because here's the reality, Shannon. none of us can predict the future. The media tries to throw it out there, and you'll have other people say, oh, that they're exaggerating. Well, maybe they're right, maybe they're not. You and I can't predict that.
Right.
We can do our best guess as to, based on today's financial data, here's what I anticipate, but we don't know. So I'm a big proponent of making your decisions based on long-term. So for example, if you bought something today and it had positive cash flow and the market were to drop by 10, 15%, remember we had that in 2007 in Edmonton, and if the market dropped and the rents dropped, would you still be able to float that property in the worst case scenario? If the answer is yes, well then the market's eventually going to come back. So it doesn't matter whether a bubble bursts or not. Eventually it will come back, and the future highs are going to be higher than today's highs, guaranteed. That will happen. So if you can float it in the bad times as much as the good times, then you recession-proof your portfolio.
Excellent suggestion. So if somebody needs to get hold of you, Peter, where do they go?
You can go to my website, www.peterkinch.com, or send me an email at peter@peterkinch.com. Kinch is Kinch.
Oh, thank you so much for your time.
Hey, it's my pleasure.
Okay.
Thank you.
Thanks.